How investment banking enhances the risk management. Welcome to the Finance Fusion, your clarity code for complex finance fundamentals. Today, we'll decode how investment banking enhances the risk management. A key component of strengthening the risk management tactics in the financial sector is investment banking. Investment banking is essential for recognizing, evaluating, and reducing risk for institutions and investors in addition to its conventional duties. Investment bankers manage uncertainty with the help of creative derivative products, specialized solutions, and thorough due diligence. The adherence to regulatory framework is ensured by their competence in governance and compliance. Investment banking stand out as a crucial ally in this changing environment because it actively shapes risk management framework and facilitates financial transactions. Also, it enables clients to prosper a complex world of economics. In the previous year, 3 of the more major risk occurrences were recorded by 41% of the firms, and more than 52% of the cybersecurity experts reported seeing a rise in cyber attacks as opposed to a year ago. Point number 1. Risk identification and assessment. Investment banking improves risk management primarily by using strict procedures for risk detection and assessment. Due to their close involvement in a variety of financial operations such as mergers, acquisitions, underwriting, and consulting services, investment banks have a distinct advantage. Because of their engagement, they are able to carefully evaluate potential risks by examining the nuances of various arrangements. According to the 65% of the senior finance leaders, there has been an extensive change in the volume and the complexity of company risk over the last 5 years. Point 2. Structuring financial products for risk mitigation. When it comes to designing financial products that act as a tool for risk mitigation, investment banks are essential. Investment bankers create products like derivative and hedging methods that enables the client to protect themselves against the unfavorable market movements through creative financial engineering. These products provide as an insurance against the future losses in addition to offering in a way to diversify. In 2024, over 46% of the companies want to raise an insider risk program spending. Investment banks also assist in development of intricate financial arrangements that aid in the distribution of risk among different stakeholders. For instance, bank can bundle and sell assets through securitization, shifting risk to investors. This strengthens the financial ecosystem and resilience and encourages liquidity in the financial markets. Insider risk management accounted for less than 10% of the total IT security budget in 88% of the firms. Number 3. Regulatory compliance and risk governance. Investment banks are essential to maintaining the adherence to risk-related laws in time of heightened regulatory scrutiny. Strict standards are enforced by regulatory organizations in order to preserve financial stability and safeguard investors. In order to guarantee that customers follow the strictest guidelines for risk governance, investment bankers are in forefront of understanding and putting these regulations into practice. Investment banks set upon strong framework for risk management that comply with regulations. This covers scenario analysis, stress testing, and ongoing risk exposure monitoring. Investment banks help create a more secure and open financial environment by promoting a culture of accountability and compliance. Number 4. Crisis management and contingency planning. Because of the intrinsic volatility of the financial system crisis, which are unavoidable, investment banks are essential to crisis management and emergency preparedness because of their extensive industry knowledge and also with the analytical prowess. Whether it's systematic disaster or a credit crunch or a market meltdown, investment banks use their knowledge to guide clients through difficult times. These organizations support the creation of all-encompassing risk reduction plan and let their customers react quickly to the unforeseen obstacles. Investment banks assist their clients in making strategic decisions and lessen the negative effects of crisis on their financial well-being. Whether those options include debt restructuring, obtaining emergency financing, or selling the non-core assets. Number 5. Capital adequacy and stress testing. An essential component of efficient risk management is the capital adequacy, which is upheld in the large part of the investment banks. As a financial safety, net capital absorbs losses and keeps the companies from going bankrupt. Investment bankers guarantee that the financial institution maintains sufficient capital buffers in the relation to the risk exposure by closely collaborating with regulatory framework like Basel III norms. Investment bank also uses stress testing as a critical technique to evaluate how resilient financial organizations are unfavorable. Investment banks find weaknesses and create plans to reduce possible risk by simulating stress events on financial system and also on portfolios. This proactive strategy forfeits the larger financial ecosystem against the systematic shocks in addition to safeguarding the institution's debt. Point 6. Market liquidity and risk hedging. Market liquidity is most facilitated by investment banks, and this is crucial for risk management. The ease with which assets can be purchased or sold without materiality altering their pricing is referred to as a market maker. Investment banks serve as a market makers, creating a ready market for a range of financial instruments, which helps them to facilitate the liquidity. Investment banks are also very important in risk hedging. They provide market players their ability to offset and manage their exposure to price variations, interest rate changes, and currency movements through the use of derivatives like forwards and futures and other financial instruments. In addition to safeguarding investors, this risk hedge keeps the financial market generally very safe. Point 7. Technological advancements in risk management. Technological developments are now essential to risk management in the modern financial environment. Investment banks improve their risk management skills by utilizing cutting-edge technology like big data analytics, machine learning, and artificial intelligence. Investment banks can now make data-driven choices, uncover emerging dangers, and evaluate enormous data sets in real time thanks to this technology. Adoption of blockchain technology also lowers the risk of fraud and operational errors by improving the security and the transparency of the financial transaction. Investment bank can keep ahead of the curve in recognizing and mitigating changing risk by actively investing in incorporating these technologies into their risk management. To sum up, investment banking actively supports the risk management techniques, going above and beyond its conventional function as a financial intermediary. Investment banks enable investors to manage the complexity of financial markets and completing extensive due diligence using the advanced risk modeling techniques and creating creative financial products. Investment bankers' knowledge of governance and compliance makes them enhanced, and the framework becomes much more viable and robust for a long-lasting financial system. Our journey into this financial clarity doesn't end here. Explore our archive of videos for a wealth of knowledge just waiting for you. If you found value in our today's video, give it a thumbs up, subscribe for our future insights, and share it with your friends. Remember, the more we learn together, the stronger we become. Thanks for being part of the Finance Fusion, your compass to financial enlightenment.